What the heck is value investing? It's a very commonly used term by more than people who just believe in value investing. As you've seen, Cathie Wood, who talked very critically of value investing 2 years ago, now talks about her investments being in deep value territory. So what is it? Well, in a very basic term, it's the idea of buying a dollar for less than a dollar. Now, Warren Buffett would sit there and say that there's no such difference between investing and value investing. There's a margin of safety involved in value investing, but there should be a margin of safety involved in anything you do. For example, you get in the car, you put your seatbelt on. You clearly don't know if you're going to get in an accident. In all likelihood, you probably won't. But the downside risk of not wearing your seatbelt, such an easy task to do when you get in the car, could lead to a problem that could be catastrophic and end your life, correct? Same thing applies to value investing. Obviously, without ending your life, but the idea is we don't know the future. We have no clue what's going to happen in the future. Some of the brightest companies in the world have fizzled out so fast, and you have no idea why. Look at a company like Blockbuster. In the 90s, it was unbelievable. This company could not miss. I believe it was Wayne Huizenga. He sold them off, made a ton of money, and then by the end of 2009, it was completely gone. Okay, so value investing, to me, is all about being realistic about what the future holds and not overpaying for the future, okay? The future is awesome and bright, but you can't even tell what's going to happen a week from now. How the heck are you going to be able to say what's going to happen 10 years from now in a very complicated business involving thousands of people running it every single day? Not only that, you have world economies running. So the idea behind value investing needs to be understood by how does it actually happen? So if you believe in emotions, and if you believe that people's emotions can affect their decisions, then you should believe in value investing. As simple as that sounds. So let's take, for example, any sort of investment. Would we not agree that there are some times that we're very, very happy and very, very sad? Forget about investments. Talk about a relationship. Have you ever had up downs and down times in your relationship? Anybody who's watching this is obviously going to say, well, of course I have. Now, does every uptime last forever? No. Does every downtime last forever? No. And sometimes the downtime is a permanent thing. You break up, you get divorced. And sometimes the upside is a great upside, but things can get better, or things can get a little bit worse, but still be good. That's the idea behind value investing. The idea is to take people's emotions that they feel about a certain business and see where there's mispricings between price and value. Value investors don't see price as value. Everyone else in the world sees a price and says, what's the value of it? We do not. We sit there and see a price and say, this is the market dictating what they believe the value to be. But based on history and fundamentals and blah, 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 we believe the value is X. Our goal is to see when price is lower than value by a large enough sum that our assumptions can handle the things we don't foresee. Now, is it flawless? Of course not. Because if it was, all you do is go out there and say, well, what's the one company that's most undervalued? I'm just going to put all my money into it. So Warren Buffett says that diversification is for people who really don't know what they're doing, which does make sense. But even having 10 companies versus one company is some sort of diversification. There's a great book written called Good Stocks Cheap by a guy that we interviewed here, and he was wonderful, and he holds less than a dozen stocks at any given time. He likes less diversification than we do. But to really understand how to unlock value in a company, you need to understand the fundamentals of a business. So I'm going to break it down in a very, very simple way. Now, this simple way, you might sit there and say, well, Paul, that's easy to say when there's only 10 shares, but I'm trying to break it down in a company that has only 10 shares. So let's say there's a company out there. It generates $1,000 a year in profit, okay? And it has 10 shares outstanding. That means every year, each share gets $100. Okay, great start. Let's assume the balance sheet is clean, assets and liabilities are equal. If they sold off everything, they would get exactly $0. So we're basically following to look at just the company's cash flow, okay? Just the earnings it spits off. Now, if you want a 6% return or 5% return on your money, you would take the $100 per share and divide by 5%, which means you're willing to pay $2,000 per share. Why? You pay $2,000, you have 5% return, you get $100 per year. That means the entire company is worth $20,000. All right, to you. That's 10 shares times $2,000 a share. Very simple, right? Great. Now, how do we go from here? Let's say the market suddenly hates this company, okay? Suddenly the market hates this company, and each share, instead of being $2,000 a share, is selling for $1,200 per share. Now, the average person out there will look at it and say, man, this company sucks. Look, it's down 40%. A value investor would sit there and say, well, wait a second. This company keeps making $1,000 in profit at $100 per share. It's selling for $2,000. What happens here? Why would there's got to be a disconnect here. So what are they going to do? They're going to start buying shares of the company. So they buy the first share. They pay $1,200. Now, the theory behind value investing, and every single year, by the way, that balance sheet, when we initially bought the company, it had 0 on there. But every year, that balance sheet gets $1,000 more in its bank account. It's not paying out any dividends, not buying back any shares. For right now, they're getting $1,000 more. Okay, let's fast forward 10 years, okay? And let's say the stock stays at $1,200. But now, 10 years later, you still have the business generating $1,000 in profit. But now, you have a bank account with 10 years of $1,000 in it, plus $10,000. So now, you're sitting there saying, wait a second, the company is selling for $1,200 a share times 10 shares, $12,000. If I just buy the company and empty the bank account, I've only paid $2,000 a share for the company. So the idea behind value investing, and this is, you might sit there and say, this is going to be tough to do, but the idea that Warren Buffett and Ben Graham talk about back in Security Analysis, Intelligent Investor, and all of their annual reports is, the idea is somebody somewhere who's big enough will see the value there and will start buying up the shares to either release this $10,000 or to redirect to make it private and say, hey, I just bought a company for $12,000. I got $10,000 back for buying it. I paid $2,000 and it's giving me $1,000 a year in cash flow. I will gladly pay $1,200 per share for it. That's the idea from an acquisitions part of how that happens. Again, I'm going to repeat till I'm blue in the face. It's easy to stay on 10 shares, but you're out there saying, Paul, but Apple's got 4 billion shares out there, whatever the number ends up being, 40 billion shares. How can I possibly take it over? Well, that's the best part. Markets go through swings. And part of those swings is, if you look back 10 years ago with Microsoft, this is the example I always get. It was the first time that people actually looked at me and said, boy, Paul, you are stupid. I was looking at Microsoft. It was selling for 9 or 10 times its profit. Less than this. It was making $1,000 a year and selling for $9,000 or $10,000. And everybody's like, this company is dead. So the public perception was, this company is dead. But then I looked at financials and their revenue was going up 8% a year consistently with projections out in the future for at least that. And their profit was going up 11% a year with the projections still carrying on. I was like, man, how is a dead company growing? The idea of dead means it's gone. And even dying, it's not even dying. It's still just growing. So I bought some shares. And then other people started to pay attention, not because of me, and they started to buy shares. And what ends up happening is people start seeing the stock go up, or they start buying in, or when big bubbles pop, people suddenly care about cash flow and profit. Look at the example of Uber. The Uber CEO recently came out and said, the market has changed. We need to focus on cash flow because that's what the market wants. The more and more the market eventually wants safety and security, they're going to go to the companies that are selling, the best companies selling for the lowest price for cash flow and earnings. That's the way it goes. Now, what if you don't have some big person coming in there and taking over the company and buying it all out? What happens then? Okay, well, this is what we can do. This company is still generating $100 per share in profit, okay? $1,000 a year. You own one share. And it's selling for $1,200 a share. Well, if the company is smart, you know what they're going to do? They're going to take their $1,000 and start buying back shares. Okay, so let's say 4 years from now, they've bought 5 years from now, they have $6,000. Over the next 5 years, they have bought 6 shares out, right? Because they took $1,000, times 5, $5,000. And let's say the stock stayed at 1,200. Divided by 1,200, they've bought back 4.16 shares. So call it 4 shares. So now the 10 shares, $1,000 in profit is now divided by 6 shares. You still own your 1 share. Now the profit per share is $166 per share versus the $100 a share before. Now when you assign, even if it's only going to be 12 times profit, what do you have here? Isn't that $2,000 a share? That's another way to drive value, okay? When they start buying back cheap shares, it decreases the number of shares outstanding for all the investors out there. You still keep your number of shares, but now they're splitting the profit, revenue, everything by the number of shares outstanding and driving up that per share profit. Look at a company like Best Buy. Best Buy reported today and they crushed it, but they're buying back a lot of shares. So even though their business might stay stagnant, if they stay cheap enough and the company can buy back enough shares, that's how they can drive up the earnings per share. And therefore, when you apply your multiple of 12, 13, 14, 15 times earnings, that is how you drive up the value per share. Does this take time? Absolutely. Can you still be wrong? Absolutely. But that's why for me, I focus on larger companies. I focus on companies that I think have a less likelihood of going to zero. They're going to stick around for a long time. I will see mispricings in the largest of largest companies at some point. Why? Because I see mispricing in the market at some point overall. Look at 1982. Look at today versus 1982. And by the way, guys, I really encourage you to rewatch this over and over, because the 2 major ways of unlocking value would be somebody to come in and buy the company and buy everybody out at a higher price, or the company buying back so many shares that you get such a big piece, growing piece of the profit of the company that you sit there and say, listen, I don't care. If they keep stacking up their cash, eventually they're going to give a big one-time dividend. That'll be a huge number. And maybe you paid, using the same example, $1,200 for a share. But if they spend 10 years accumulating $10,000, they might sit there and say, listen, we're going to give out a one-time dividend of $1,000 per share. Would you take that? Of course you would. You'd absolutely take that. You pay $1,200, you can get a one-time dividend of $1,000. Give it to me. And now you still own the share of the company and still going to cash flow. This is the idea behind value investing. It takes time. That's the hard part. You can see a value stock still go down and wonder, am I right or am I wrong? That is the hardest part of this all. So back to 1982. One of the most reliable metrics for stock market value is the stock market to GDP ratio. This is something that Warren Buffett has said at any given time is the most reliable metric for values at any point. In 1982, it was roughly 35%. So the stock market value versus GDP was 35%. Today, it's 166%, give or take. Call it 160. Almost 5 times more. So the same dollar of profit and cash flow costs 5 times more today than it did in 1982. And I'm not saying in terms of, well, of course, Paul, there's more profit. No, I'm talking about ratios. The same $1, $1 here, $1 here. It costs here 35 cents, essentially, and it costs here $1.66 to buy the same $1 of cash flow, okay? So when this happens, all stocks are low. And I can buy really big numbers. Now, does this happen often? No. This was one of the lowest in history. It might have even been lowest since even lower than the Great Depression. But this is one of the lowest times ever. But the point is, when the markets as a whole go undervalued, I can find some of the best names at cheap prices. Look at Microsoft. Microsoft was untouchable in 2000. 12 years later, I was able to buy Microsoft for 9 times earnings. And I regret selling it at 60. It was like 55 or 60 I sold it. I regret that. I was just like, man, this thing has flown up. It's maxed out its value. I didn't realize the value of their cloud-based computing and how amazing they're going to do with their software. Okay, I sold too quickly. Understood. And that's one of the perils of value investing. You might sell too quickly, go into another value idea. So the question is, has this been around forever? Has value investing been around forever, and will it be around forever? The answer is an emphatic yes. You've probably seen people say value investing is dead. Value investing may not be the best thing at a certain time, but it'll always be around. If you don't believe that, you believe that every market is efficient, and the efficient market theory does not make sense. If it was right, then then there wouldn't be people who could ever beat the market. And there are lots of people who beat the market. In fact, they all learned from one person, basically Ben Graham. They all read his readings and said, this is what we're going to do. Value investing will always be around as long as you believe in human emotion. Because you will never find in history that one sector or one business was always the best one or the worst one forever. It has never, ever happened. And it will continue to never happen. The point is, value investing will never die. If you watch this right now, you don't believe me, I'm not the channel for you. And I'm okay with that. But if what I'm saying to you right now resonates well, just remember, there are people out there who believe in us. We have a community here with our software of thousands and thousands of people who chat in here based on value investing ideas. And guess what? Some of them think Tesla is a value investment. I don't agree with them, but some of them do believe that. They believe the future for Tesla is way bigger. Value investors always think similarly, but they don't agree on everything. That's the big key here. They're going to think very similar. They're all going to sit there and say, I'm going to discount certain cash flows. I'm going to assume this and that and the other, but they will all believe in a certain framework of how they fit their process. If you like this, please subscribe to our channel. And if you want to learn more about margin of safety, please watch our next video where I explain margin of safety in a little more detail.